my mind. Looks like we're in the click.
What is going on, you guys, and welcome back to episode 8 of our portfolio building series. Dad, what's going on over there?
Hey, Brandon, all's good here in Paul River. I can't believe we're on episode 8 already. It seems like this time is just flying by.
It has flown by, but as we are gonna touch on later in this video, we're only 3.5 months into this challenge, eh?
Yeah.
So, I mean, it's been fun, it's been awesome, but we are still really in the early innings, and we do have a section of this video kind of set towards that, where we're going to talk about what moves we've been making, more or less actually the lack of moves and why we've kind of taken that approach. But I don't want to jump the gun there. We can get into that later into the video.
Yeah, this will be, I think, somewhat of a philosophical discussion today, more so than, what have we been doing lately and looking at all the trades and the details. This will be more sort of conceptual. I'm really looking forward to having this discussion with you today because I think it's very, very valuable when we look at the big picture.
And we did add, over this period, we added 3 new holdings. So we are going to touch on that today. If you're curious what we bought, make sure to stick around.
For sure.
Before we dive into it, is there another COVID stream going around?
Another COVID strain. There's a new strain. I can't remember the name. It's a
crazy name. Yeah, short name.
Yeah, it's one of those Greek alphabet letters. Can't remember what it is, but it is. Delta obviously is the predominant variant right now. But apparently this one's picking up steam. And wow, I just wish we could put this behind us.
It's never going to get behind us. Maybe we're going to have to,
possibly. If we can't get ahead of this, it will be around forever. At some point, we need to tackle it, get everybody to a position where you either had it and are naturally immunized, if that even works. The evidence isn't clear on that. But then just get immunized, get that shot. And then when we get enough people there, we can start being normal again. We're back to masks. Holy cow. We're supposed to be like in a week or so, we're supposed to be back to like normal. But we're going the wrong way. We're going the wrong way.
I don't know if this is accurate or not, but I heard I think Ontario, they may do a mask mandate till next March. Does that?
Till next March,
dang.
Kind of makes sense because the winter months, right, is where people are more inside and Now I think if we do a full mask mandate, I think every time we've done that, we've seen the numbers go down. Then you relax it, the numbers go back up. So, sheesh.
Well, this isn't a COVID channel. This is a channel about stocks. So let's get on to the video today. Let's start with an overview of the portfolios. By the way, if you guys enjoy this series, please take a moment and drop a big thumbs up. As always, we do have our Investing Academy down below. If you want to follow along with our trades live, if you want more courses and training, that is below. But we're going to put up on the screen our Questrade portfolio, which as of today is sitting at $24,714. Again, these portfolios started at $20,000 if you're just joining us now. And the Wealthsimple trade portfolio is sitting at $23,633. And this brings us to a grand total today of $48,347.84 Canadian. Let's take a brief moment to look into our holdings. And actually, Dad, I find this quite interesting. The Questrade portfolio, actually, wait, my math was wrong. Your math is wrong because we're at 49,400 or something like that, roughly. That's an error. So our Wealthsimple portfolio is actually sitting at $24,633. I was about $1,000 short there. I must have just had a typo.
Exactly 1,000, yeah.
There you go. There's our new total, which I'll pop up on the screen for you guys. But what I find fascinating is that these accounts are basically neck and neck in growth. In fact, the Questrade's a little bit higher.
Yep.
But what a difference in the volatility of the holdings. And Questrade, as you can see here, we have a couple of stocks that have done very well, being Apple up 21%. If you hover down a little bit, you're going to see Google, actually, our top performer, up 25%. Pfizer's doing well, up just shy of 20%. But on the downside, you do have that downwards volatility as well. You guys know the story here with our Chinese holdings, being Alibaba and being Tencent. Those are down about 20 apiece. So you have some high flyers that are doing well. You have some poopers that are doing bad. Versus if we look over to the Wealthsimple portfolio, it's a little more steady as she goes. And I'm just going to have to zoom in on my thing here. We got Bell Canada up 10.84%. Clorox is one of the bigger downward movers in this portfolio, down 6.11%. Canadian National Railway up 20%. That's a nice surprise from CNR.
Most of that this week.
Exactly, on the news. And that was funny news. They actually, I thought it was more negative news, but nevertheless, a good pop there. Campbell's Soup, we're going to talk about that later today. Canadian Utilities, Enbridge up 6.5%, Kirkland Lake up 2.4%, Manulife down 3.8%. Moving along the list, we have two of our bond funds, which are pretty much steady as she goes from a growth perspective, but of course we're drawing in income each and every period. And we do have Royal Bank and TD Bank, which are more or less kind of doing the same thing. But how fascinating is that? We're still at the same endpoints, but with very different routes.
Well, and when we launched this this whole series, and if this is the first time you've tuned in, as Brandon said, this is episode 8, and if you go right back to the beginning, it lays out more sort of the concept of what we're trying to do here. One of the key things we're trying to ascertain is when you have these two vastly different constructed portfolios, how they act. Very interesting. 3.5 months in, like you say, very similar returns, but a vastly different path. And sort of the whole thing here, like, you know, I'm the boomer, and so I'm sort of taking the lead on the more balanced portfolio, the Wealthsimple portfolio. Brandon, as the millennial, is taking the lead on the growth portfolio. I think we're seeing exactly what you would expect to see, especially in the short term, right? Because in the short term, so much is unknown, and you're going to have huge moves in either way typically. But when you go with the more core blue chip type holdings, those swings should typically be less. And you're taking a more aggressive stance, and you're going to see that. Now, of course, as time goes by, that will be the true test is to see.
Yeah, once we go through different serious different market conditions, right? We haven't really seen much of a downwards move in the markets.
We've seen some blips, but nothing major yet.
Yeah, and I think that is where you're going to get a lot of variance too, right? We think these 20% dips are a lot, we could, as we would like to instruct our viewers each and every video, is you have to come to expect when you're an equity investor, these portfolios can absolutely fluctuate. And we could see our total value of this portfolio drop 20, 30, 40%. That stuff does happen. And it's just something to be cognizant of, right?
It just reminds me of a chart. I think we probably can get it real quickly, Brandon, but maybe when you put the video together, we can overlay that chart where it shows like the 1 year time period and the expected fluctuations. And then as you move that line out, then the range becomes more narrow and more narrow. And that's exactly what I would expect to see here. Like you said earlier, we're in the very, very early stages of this game, but we're already starting to see the difference between how it comes down to your risk tolerance ultimately, right? And so it's a good demonstration, good illustration so far.
Totally. Well, let's go ahead and actually, before we move on, I'll just pop up kind of like an overall view of our portfolio. I believe you got this nice and ready for the video.
Sure.
This kind of gives us a top level look at the different holdings. You can kind of take a look over to the right and see all of the positions. If we looked at it from a 50,000 foot view, you can see our sector exposure over to the left, and then more or less just some additional information regarding the types of shares, the asset allocation, et cetera, et cetera. But let's move on to our questions from the audience. This is one of my
favorite segments, the Q&A.
Exactly. This has to be it because, we get a chance to interact with you guys and hopefully answer as many questions as you guys have. So as always, do leave them down below if you have any more. But the first question that we're going to point out is one from Kuba. And Kuba says, thanks for sharing your knowledge, guys. You're welcome. I was wondering, what do you guys think about getting exposure to all of the Canadian banks through an ETF like ZEB or ZEB?
Or for those viewers north of the border, ZEB.
ZEB, yeah. Take it away. I don't know if you guys heard. I don't know if you guys heard, but they did drop the MER down. Did you know about that recently, Dad?
I saw that in our Discord chat in the academy.
Yeah, exactly. So one of our students did notify us of that. This is not an ETF that I invest in, but as Kuba mentioned, it's basically just a compilation of the 4 or 5 biggest banks. I think there's 5 in there, but maybe even 6. But he says 4. Anywho, rather than going out and buying them individually, you can buy them as a bundle. And they did, I think, I don't know the exact amount they dropped it down by, but a notable drop, which does make it more favorable. I think with us, we have no issue going out and buying those banks in and of themselves. And I mean, you can speak on this after, Dad, but it's not difficult to go out and buy 4 or 5 banks. It can be very difficult if you're trying to get broad exposure to, let's say the international market. Let's assume you say, hey, I want to invest in Europe or in China. Well, that's very, very tricky to do your due diligence and research and buy, a broad spectrum of those companies, which is where an ETF may make a lot of sense. But for me, when it's a concentrated number of stocks that you're looking at, like 2 or 3 holdings in the bank sector, is it necessary? My opinion on that is no.
I will add to that because an occasion where this ETF might be the perfect solution is for someone who's a raw beginner. You know that you want to have some exposure to the Canadian financial sector, but you just don't feel comfortable going out and making those calls on your own. And like you said, Brandon, when you're buying the Canadian banks, they're going to behave very much the same. So there might be some minutiae in the differences between what you would buy at any particular time. But if you just don't have that comfort level, this is a good way to get started. And then what you could do is, as you've learned, maybe start peeling out a little bit. So let's say you put 10% of your portfolio. I'm just going to take that number and put it into this. You might say, well, I'm going to peel back every quarter or every 6 months and start adding whichever you feel, maybe Royal Bank, TD Bank, CIBC, BMO, whichever you feel at that moment is the stock that you want to own directly. And then eventually, and this happens, I saw this happen when I was working in the industry, where you would eventually, I would say, migrate from owning that ETF. This could be done in the banking sector or in any sector for that matter. At the end of the day, what you're doing is you're eliminating the management fee. And so this fund will act almost exactly like the same basket of funds if you own them independently. It's just without the management fee. If you have the comfort level to do that, then it's a great alternative. It really comes down to personal preference, in my opinion, as to where you're at as an investor or your time.
Yeah. No, I think you nailed that with the beginner. You said if you're a beginner, you're new to the stocks, it may make perfect sense to just buy that bundle. But maybe as well as, with time, as you decide to start peeling off, that comes with your experience as that grows. And you decide, hey, I want to get a little more flexibility with where I deploy my money within these banks. Your knowledge of the stock market increases, your confidence increases, and you say, hey, well, I no longer need that product to buy it for me. I can just go out and buy it myself. So definitely your skill level can play a role in that for sure.
And bottom line for Kuba, if you bought this ETF and you held it for the rest of your investment life, that's going to be fine too. So there's nothing wrong with doing it this way. It's just a different way of doing it. Yeah.
Agreed. Next question comes in from Sarthak. Mital, I'm a bit new to investing and I'm confused when you talk about a stock having a good dividend. I heard over the video that sometimes the banks and other stocks with 3% yields, example banks, Clorox, I think, are counted as stocks with fantastic dividends, and other times it goes as high as 6%, like an Enbridge. Why is this? Shouldn't stocks with yields in the higher range be considered as good dividend stocks, or am I missing something?
Well, I think what we can do right now, Brandon, put some nice background music and just put the answer from one of the other viewers on the screen. Kun Huo, he replied to this, and he just has an awesome response. I'm just going to pick a few of the items that he talked about here. The first thing he talked about is the dividend sustainable? Now, very simple, and I think we have in our dividend series, our income series, we talk about the difference between a secure dividend and a more, I just call it a risky dividend. Generally speaking, all else being equal, the higher the dividend you're getting from a company, there is an inherent higher level of risk that goes into that. If your goal is to you can sit back, relax, and really hardly ever worry about the dividend not being paid, because for those of you who don't know, dividends aren't guaranteed, then you can go with in the more normal sort of 3% range, I think Sarthak said here in his comment. If you want to stretch that yield and you want to go a bit higher, you can. Just understand that it's a different thing. Kuhn also says here, earnings that are not paid as dividends are still earnings. His point is the fact that a company is paying a lower dividend, they're taking that money, hopefully, and doing good business things with it. And we think back to a lot of startup companies, the largest companies in the world today, for years don't pay dividends. Mm-hmm. That doesn't mean that they're bad, because they're taking every dollar they can, putting it back into the building the business, and at some point they're going to implement a dividend stream, and we see that very, very routinely as companies go through their life cycle. So there may be another reason why a company has chosen to pay a lower dividend than a competitor, or typically a company that's in a later stage of their development. Anything to add to that, Brandon? Or?
No, we talked so much about dividends. I think that kind of does just summarize it.
Sorry, I forgot to mention, specifically in the comment, it references ZWC. And it's important to know that fund or that ETF has what's called a covered call strategy in as part of the mandate of the portfolio of the fund. So that's an entirely different ball game. So the higher yield isn't a pure dividend yield. It's a combination of dividends and the income that's being generated by that covered call strategy. So that's not really apples to apples if you're comparing like a Royal Bank dividend, for example, to a ZWC, because of, we won't get into the details of that, but that's important to be aware of as well. Bottom line, I would say this type of thing, like really anything else, higher risk generally equals higher reward over time, but also, more risk.
Vice versa, yeah.
Or vice versa. So, important that you just understand what you're investing in, but...
yeah, and I guess I will tag on one more point there.
Yeah.
It also really depends. I would say not all dividends are created equal. And depending on where you are in your investing life, a certain dividend stock may be better for you than another dividend stock. And, for example, if you are at a point in life where you're saying, hey, I'm entering retirement, or I want my dividends to fund my lifestyle, I'm not going to be making as much income from my job, maybe then you do put the priority on those higher dividends. Maybe you find a secure dividend like an Enbridge, for example, that you feel is reliable and you're actually generating more cash flow on an annual basis. That doesn't discredit a stock like CNR, which has a tremendous dividend growth rate and a tremendous dividend track record, but it is a much lower dividend. These dividends can both be, let's say, on an equal status, but for the certain type of investor, one may prioritize the higher yield at the moment. One, maybe a younger investor, may prioritize a stock that's actually growing their dividend faster. You can't just look at the yield. That's just one piece of the equation. One piece of
the puzzle for sure. And just I just realized this also. We have an overlay here that you can throw up on the screen, Brandon. And this is the U.S. market, the S&P 500, but it shows the dividend yield for the last 50 years. And you'll see that in the last 25 years or so, you're looking in that 2% range. Now the TSX I think has a higher dividend yield because the index is so focused on the banks and the energy companies. But across the way, so if 2% south of the border is a longer medium-term trend, then you could say 3 or 4 is a good, because how do you define good? And I think that's the meat of the question. So I think everything that we've said about the different things you want to factor in, and then say is 3 or 4% good? If it serves your purposes, then I would say it could very well be.
For sure. Let's move on to another question.
Sure.
From Tyson. Wow. Thank you for answering this question, Kelly. I don't know if he's replying to someone's question here, but he says, and thank you guys for the tip on using RSI. For long-term investments, do you recommend the 14-day period on the daily chart, or should we look at longer intervals and periods for that entry point? And I believe we have another chart that we can pop up on the screen, but this will be our last question for the Q&A segment.
Sure, and I'll just cover that off, Brandon. And he was asked what Tyson was referring to in the previous update. I think we had used the RSI as a measure as part of our analysis, and Kelly had asked that question, our previous question, and so now he was just sort of following up on that. But basically, just for those of you who aren't familiar, the RSI is a technical metric that it's called the Relative Strength Index, and it's a momentum indicator that we, as part of our analysis, will often refer to. It can give you a clue. It can give you one piece of that puzzle as to where the momentum is in a company. Is it trending down and it got into an oversold position where the markets are just beating it up, or conversely, has the market just bid it up so high that it's now in that dangerous territory? So his question is, do you use the 14-day period? And that's typically what we use. So I'll try and explain this in a few words here, but generally when you look at the measure of the RSI, you use a time period. 14 days is by most measures the default. And if we look at the chart that we prepared here, the blue line at the top is showing that 14-day RSI. And this goes back for 5 years, and you'll see two lines in the upper part there. You'll see a dotted green line and a dotted red line. And the dotted red line indicates a level of 30, and the dotted green line above that indicates a level of 70. So generally speaking, if the RSI trades below that red line, it's considered to be under or oversold. And if it trades above the green line, it's considered to be overbought or overvalued. So when we look at this 5-year chart, you can see the occasions where the blue line, that indicates the Royal Bank RSI, trades above the green line, and when it trades below the red line. So that's an idea of, that's when you would use that as part of your analysis. Now, when we look at the orange line in the middle, same concept, but this is now measuring the 7-day RSI. And what you're going to see, because it's a shorter time period, you're going to see a lot more of those time periods where it goes above 70 on the overbought side and below 70, or below 30 rather, on the downside. And then to complete the analysis here, the green line shows a 20-day period for the RSI, and you'll see there are fewer time periods where it goes above and fewer that it goes below. Essentially, if you're a day trader, if you're a frequent trader, you definitely want to go with that shorter time period because you're in and out of the position all the time, and you would react to those shorter term occurrences.
More fine-tuned, I guess you could say.
It is more fine-tuned, but it also can lead, RSI isn't a perfect indicator, so it can also lead to false flags. So it might show overbought, you might sell out of it and it continue to go up, or vice versa. It can show, hey, it's really oversold, and yet it can be a laggard for quite a period of time. So if you're extremely nimble and you really know what you're doing, the shorter RSI can help you identify those spots more frequently. People could argue, if you're a long-term buy and hold investor, why does it even matter, or why not even go, like say, with the 20, so you're not you're not making so many trades. Nothing wrong with that at all. I just tend to default to the 14 days. We are buy and hold investors. That said, we do manage the account, so there are occasions where. And I think one of the examples, we're going to be coming up with a purchase I made. I've got some alerts out there, and when certain companies go above or beyond these levels, we'll be alerted to it. It gives you a notification, and I don't want to be looking at this every 4 days as it's going up and down. At the same time, there are opportunities that come up using that 14-day. That we're comfortable with that time frame. So personal, but I think if you went with 14 days for most people, especially for longer term investors, you're going to be just fine. It's a good, comfortable number that we work with.
Totally. And yeah, one other thing, I know I've gotten questions before. Depending on what sites you use too, that 30 and 70 band sometimes is different. Sometimes you'll see it at 80-20. Sometimes it'll be just adjusted. And you can go ahead and adjust those in your settings. But by default, we work with the 30-70. And I think that's kind of the standard. But anywho.
Good point.
Sorry?
Yeah. That's a good point, yeah.
It's a question that I do get.
Yeah.
Thank you guys for the amazing questions.
Yeah.
If you guys have more questions like these that you want clarification on, that you're learning from, take a moment now or at any point during the video and leave them down below, because each and every video we do this segment, and as you said, this is one of our favorite parts of the segment. It's trying to get into it. So thank you guys for all the great questions. These three we highlighted in particular. If you guys are enjoying the video, by the way, I'll just remind you, please do give it a thumbs up, because let's move on to the additions that we made in the portfolio. And we added 3. Here on our little notes tab, we have Baba, we have Campbell Soup, and we did add some Lockheed Martin, which were the 3 throughout the period. But let's talk about Baba first, as I know, we've done videos on the Chinese market, and if you haven't heard our thoughts on that and where Mark and I actually disagree, you should go check out that video, because we had a lot of fun making that one. But nevertheless, this is a trade that actually dates back all the way to July. So we haven't, since our last update, about a day or two after that, we did end up adding Alibaba. The price that we paid was around $193 for that trade. So the shares have come down. Today they're trading at $170. And I'm hoping that we're starting to see a little bit of a bottom. We've seen the stock kind of tick up from here. But just in general, this is a very, very simple case of us averaging into our position. And I guess we could use the term dollar cost averaging if we want to use that term, which gets broadly used. But again, as we talked about at the top of this video, the holdings in this Questrade portfolio are significantly more volatile. Now, as we're in a position of building up our accounts, which we absolutely are, we're in the accumulation phase, this can be swung into our advantage if we have the cash available and if we build into our positions properly, which is essentially what we're doing here. If we went into our Alibaba position, Dad, with a full position right off the bat, we'd be pretty hooped and we'd say, darn, we're down 20% on this. I don't really want to add more capital. But because we came in with the idea of buying in batches, this is exactly what we did. And we didn't quite double down on the position, but we took a pretty significant nibble to get in at a lower cost. And I don't know about you. We have talked about this off camera briefly, but we're not going to be going too heavy into this, just because we don't want our allocations to be too high in these certain areas of the market, right? It's almost like, if we're liking the stock at this price, it may be a case where we kind of have to bite the bullet, be patient, and we don't want to although there is potentially an opportunity here, which is what I stand behind, you don't want to overexpose your portfolio, and these nibbles will get it to a reasonable size. But that's essentially what we did there with the Alibaba stock. And with Tencent, we actually decided to hold off on Tencent right now because I think they're in a little bit of a different position with all of these regulations that are coming in. I think they're actually a little more exposed than Alibaba, in particular their gaming division. Nevertheless, we've seen both those stocks start to bounce, hopefully forming a bottom here.
Well, I think this is a good example, and I've used this strategy for years. If you're taking a new position, and here every position was new because we're starting the portfolios back in May. If you have an allocation, whether it's 2% or 5% or 10%, whatever your ultimate target is for a holding in your portfolio, I've always been an advocate of taking at the most, say, half a position. So if you want to get a 5% position, ultimately take 2.5 now, participate. That way, if the company grows, if the stock value does increase in the short term, you will participate, but you're not getting greedy. There's probably a reasonable chance that it's going to pull back in the shorter term, especially where we are with the valuations today. And so then you take your 2.5% position. If it does pull back, you add more, or even if it's flat, you periodically. This is where you're sort of that dollar cost averaging in, or in this case, averaging down. It works. It's a good strategy that works, and it takes a lot of the risk out of the from the get go. And yet allows you, but you have to be monitoring the portfolio like you are in these particular companies here and making that call. It does take me right back to, the first major market crash in my career, which is the tech crash back in 2001. It was scary, but even, the companies, it seemed that they were extremely volatile. If you just kept adding in a methodical way on a regular basis, you ended up doing very well and much quicker. If everything works out with Baba here, the script is yet to be written, but if it does, by taking this little extra nibble now, that will it averages at lower cost base, so the recovery will be just quicker than if you just sit and let it come back, which is fine too if that's what you want to do.
Absolutely.
Yeah.
You added a stock in the Wealthsimple portfolio, and that was the pick Campbell Soup.
I did. I'll talk about that for a minute. I did add Campbell Soup. It was a new addition to the portfolio, and this is what I'm looking for the most part, because the mandate of the balanced portfolio, of the Wealthsimple portfolio, is to have less volatility. And we're going to talk in this video today about where the markets are at, and I don't like the valuations the markets are at right now. So taking more of a defensive play on this. First step, I got I mentioned earlier I have a watch list, a couple of watch lists that I get alerts on, and so in this case, I subscribe to Stock Charts, and I did receive an indication that they identified Campbell Soup as possibly oversold oversold with the improving RSI. So this kind of goes back to that RSI indicator that we're looking at. So that put my focus on Campbell Soup. My next step was to look at some of the technicals and just see, okay, let's sort of round out the picture a little bit. And if we look at this next chart, this is where we're going to look at a couple of indicators I looked at here. One is the RSI, and we'll see that in the lower part of the screen had dipped down below 30, so it might be an indicator that it's time to take a closer look. The stock had also pulled back around 14%, as you can see in sort of the top part of this chart. And so the 200-day simple moving average is another indicator that I typically overlay just to see, is the stock trading above or below that average? You can see here significantly below that average. So when I married those two things up, I thought that this might be a good time to add to the company. So then I just rounded that off with a good old-fashioned fundamental analysis, and you look at the dividend is paying in the 3.5% range. It's in the consumer staples space, which in highly valued markets is always a good place. So for a lot of reasons, I won't get into everything I like about Campbell Soup in this video today, but those are the reasons that I did decide to add it to that portfolio. So I took a position in there of, I think it was 20 shares. So let me just have a look and see what, it was 20 shares that we added back August the 9th. The price that we paid for this company was $42.38. And as you mentioned, it is up marginally from there, and I don't expect much to happen in a month's time period in any event. So it's just, I'm happy to have it as part of that portfolio, adding to that defensive sector, and we'll see where it goes from there. But I hope that's a bit of the logic behind why I chose, first of all, why I identified Campbell Soup as a possible entry into the portfolio, and then ultimately the decision-making process as to why to enter it, why to actually add it.
Yeah, and I wasn't following Campbell Soup as closely, but I just did a video on Kellogg's, which
yeah.
very similar category,
Yeah.
very similar company based over in the States. I was talking about the weakness that we were seeing in the consumer staples sector.
Yeah.
So Kellogg's as well was down. Another stock that I was looking at quite closely was Unilever. These stocks have started to pull back, which is, I guess, why we've seen that lower RSI. We started to see the opportunity there. And although we weren't looking at the exact same company, in general, I think we had the same thoughts on that broader category.
And you're often going to see that when we have, I mean, and the markets are quite volatile right now. We'll see certain sectors, getting ahead of themselves, and we're going to see certain sectors getting behind. I would say, pulling back, and it could be looking at some good opportunities.
I agree. Well, one last final addition that we made was a very simple one. In fact, we added one share, one whole share, not a fractional share, just one whole share of Lockheed Martin. And we've spoken before on the channel a million times about Lockheed Martin. I have a very high level of confidence with this stock going forward. I believe it's undervalued, and this was just a simple case of, again, averaging down. I know it's only one share, but we actually own a total of only 5 shares. So we had 4. We just kind of nibbled with the one. But I don't think too much else has to be said about that. Lockheed Martin, we're down about 7% on that position, and it's just deciding where we should deploy our money. Because I think we can now transition to, I think what's going to be another very important part of this video is what's with the lack of trades that we've been making. And, it's been a month and a bit since we did our last update, but why are we waiting? What are we waiting for?
Yeah.
I got some questions on my last video saying, oh, you're a hypocrite. You're timing the market, right?
Right.
And I think I really, really respect that comment, actually, because we always say timing the market beats timing the market. Why aren't you always investing? And that's what I think we want to talk about here today, because it's a very, 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 very important touching point.
Probably the most important part of what we're going to talk about today, as a matter of fact. And again, this is sort of more the philosophical or the strategic method as opposed to, what we're actually doing. But just a little bit of thought process. I'll start off with a few points, Brandon, and then we can sort of just open up the dialogue. But we touched on this earlier. We're 3.5 months into this process. And you will hear the argument if you come into a chunk of money, and in this case, we just added a chunk of money from zero into the portfolios. We know that the markets move up more often than they move down. So why don't you just put everything in, and over time you'll come out further ahead. And if we stretch that line way out, you could make that mathematical argument.
Fair argument.
It's fair. Now the reality is though, we're talking with our viewers who are real people, and we are real people. And you can look back and say, the math works in your favor this way, but we're going through, everybody goes through emotions. And a big part of successful investing is managing those emotions. And so the average person, especially someone who's a beginner, and a lot of the people who are part of our academy and viewing these videos are new, if you put your full chunk of money in day one, and then if the market's corrected, so whether it's even 10%, that would be scary, but 20 or 30 or even more, that could scar you for life. And if you're a seasoned investor and you just, you've been through the ups and downs and you have that inner fortitude, which is really hard, even for veterans, then sure, go for it. But the average person isn't going to be able to ride that out. And especially if you don't have more money coming in to dollar cost down, it's just, I would argue it's too risky of a proposition from a psychological standpoint, not necessarily from a mathematical standpoint. What are your thoughts on that, Brandon?
Yeah, I 100% agree. We've been talking all throughout this video about how we're averaging into positions and how we have this capital set aside to do so. It's all part of the bigger picture behind how you put money into the markets. And, psychological point aside, I don't think we are even closely timing the market just because we're being slower on purchases. When we started this challenge off, we set, and again, you can go back to those previous videos, like the first or second one where we talked about our strategies. We set our target allocations. We're not expecting both these portfolios to be 100% cash. 100% equities, 100% equities.
Yeah.
Absolutely not. We set an allocation for bonds. We set an allocation for our cash targets. And yes, we are higher on the cash target right now. Like we're basically taking the full advantage of what we set for our cash targets, but we still have 80% of our portfolio invested, right? I think that's the difference when people say, oh, you're timing the market. If we had 100% of our cash on the sidelines, which a lot of people do.
Yeah.
When you look at what people do, they say, yeah, well, I'm just waiting for that right time. I'm waiting for the markets to come down.
Yeah.
And they are literally holding 100% or 80% or even 50% of their assets in cash. That, I think, is timing the market. Check out what we're doing. We have 80% in the market, or in our balanced portfolio. We're targeting a 60-40 split, but we have money in fixed income. Yes, we have cash, but we're still within our targets, which is why it's so important to set those strategies. And yes, we've been slower on the buys, but that's selective investing. That's not timing the market. That would really be my way of saying that.
I would say that's very well said. Very well said. And if we go back to March of last year, I know of people who took their money out of the markets, middle of March when the markets were falling, went to cash with the expectation that once the markets recover or are looking better, I'll get back in. Well, that's definitely timing the market, because you are now exiting the market. And generally speaking, if that's your inclination, you're not going to, add it back at the first tick up. You're going to wait until we see strong recoveries. The recoveries typically come very, very quickly. And we've seen that in, this last go around. So then at some point, okay, now I'm going to get back. We're not in and out of the markets. An analogy that we talked about earlier, Brandon, I think is applicable here, because I know you golf, is...
I try.
For those you try, you hit the ball. For those golfers, when you're looking at a fairway, and you can see a lot of fairways are big, wide open spaces, and even the average golfer can get out the driver and take a whack at it, and the margin of error is pretty big out there, right? And so there's times when I would say the markets are valued at a big, wide fairway. There are times when that fairway is much narrower, or the landing spots aren't as forgiving. And right now we are in, and we're going to talk a little bit more here soon about how we're measuring the width of the fairway, or in this case, the markets. We're in a place right now where that landing area is pretty small. So there's nothing wrong as a golfer of scaling back and taking out your 3-wood or your 5-wood or hitting a long iron. Yes, you're not expecting to hit it as far, but for this particular fairway, you're just mitigating. You're balancing off the risk with the reward, because the risk of taking too big of a swing, you're out of bounds, or you lost your ball, or whatever the case may be. And I see this very, very much the same right now, where we're not trying to hit the longest drive we can. We are hitting the ball. We're not stopped.
We didn't stop swinging. Exactly.
Yeah, so hopefully that can resonate, and I really see that as, no, we're playing the game. But we're, like you said, about 80% of the money is invested in some form right now. So I agree. We're not timing the market. We have most of our money in the market, but we're calculating, taking some educated calculations here as to what the best allocations would be given where we're at right now. We're okay with the odds. I mean, right now I think the odds are against us, but we're still playing the game, and we'll see how that turns out in the shorter term.
Yeah. You should have watched the tournament. There was a really good tournament last week. It went down to a playoff with DeChambeau and then Cantley.
Okay, yeah.
And it was just so crazy to see their difference in approach. I mean, Bryson's obviously smashing the drives, every single one, and Cantley's more or less just placing them in on the fairway.
Yeah,
and there's literally 30 to 40 foot yard difference on every drive.
Yeah.
Cantley came out the winner, right? So we're not always striving for, it's not always time to just full on whack in the markets. Sometimes the more strategy can be the play, right?
Well, that's a very good example, and I think investing is much the same. Now, I guess that's going to lead us into the next part of our video here. And as there's a lot of disagreement out there as far as whether you should be invested, whether the markets are going to go up, whether the markets are going to go down, and none of us know going forward. But there's something that we can do, and we can measure the markets. And there are metrics that we can look at that we can determine, okay, where are we out there? A boating analogy, if you're out boating, you can measure how fast the wind is moving, right? And you'll know how that will affect the waters. And you can still choose to go out in your sailboat or in your motorboat, even if the winds are high. You just have to know what you're dealing with, your choice. Or if the winds are too high, you can decide to maybe stay in the harbor until a little bit later. And we're seeing right now a very windy scenario, I would say. And what we're going to do in the video today, and I hope this resonates with some people, is we're going to look at a number of charts. And for those of you who are listening on the podcast version of this, only this next section, it's going to be fairly graphical in nature. But you can maybe go back and catch the tail end of this video on the actual YouTube channel if you want to see that. But let's measure where we are in the market. So first of all, let's start with an overall valuation. And the first chart I want to look at here is a chart that JP Morgan prepares. And this just shows the forward price to earnings ratio of the S&P 500. And a quick glance at the chart. Move your eyes to the right-hand side of the chart, and we're going to see this is as of June 30th, the most recent report that I pulled from them. But we're seeing a PE of about 21.5, and that's just a measurement of the price to the earnings of the industry, of the sector, of the index as a whole. Mm-hmm. When we look back over time, so the middle of the chart roughly shows the 25-year average is 16.7. And when we look at when the market has been as high as it is today, I'll just summarize, the results haven't been pretty. And when we, there's a little bit of a table at the upper hand part of the chart here, and it shows, the latest number, 21.53, the 25-year average, 16.71. If you look at the Shiller index, latest 37.7, 25-year average 27.7. The price to book ratio, the fourth one down, 4.19 right now, 25-year average 3.02. And finally, the price to cash flow, 16 versus 11 on the longer term average. These are measurements of the valuation of the market. And as much as you love the fact that we've mostly been making money for the last year or so, you can't ignore these. And a seasoned boatsman would look at the forecast and say, where are we today? And the winds are really blowing right now, as I said. So this is something we have to be aware of, and we just can't ignore. I'm going to look at a couple more charts here, Brandon. And the next chart I want to put up is the concentration of the S&P 500. And if we look at the left part of this chart, there's the greenish line is the top 10 constituents of the S&P 500, and the black line is the rest. So you look at the Amazons, the Apples, the Microsofts, the Googles, the Facebooks, the Teslas. The top 10 companies in that S&P 500 are currently trading with a price to earnings ratio of over 30, or right at 30, and so that's essentially double what the long-term average is. So if there's a lot of people today who are growth investors. And so you might find your portfolio really over-concentrated in this sector. It's just getting riskier and riskier all the time. Quick example, that's maybe why we put some Campbell soup in, because we want to have some of that bottom part as well, which is statistically less risky. Another chart I want to look at, and this is a complicated chart here, but I'm going to try and explain it the best I can because I think it tells a really good story, is a scatter chart. And on the left side of this chart, for those of you who aren't familiar with how a scatter chart works, but on the y-axis, so on the left-hand side, it shows the percentage of return. And this is the S&P 500 as a whole. The x-axis along the bottom shows the PE ratios in this time. So the further to the right the dot is the higher price to earnings ratio, and the further to the left is the higher return. And you can see where the red dot shows us now, or a couple of months ago, we're at that 21.5 range. What this chart tells me, if you look up or down from where that dot is, you see more downside. So this looks out over the next year, from where we are today over the upcoming year. Historically, what has happened, there's way more downside potential right now than there is upside. It doesn't mean there isn't upside potential, but there's more downside. If you just go back sort of to the middle, let's say, look at the bottom axis where it says 14 and you look up, you see the returns are much better, much more predictable in that case. Even more glaring to me is the right side of this chart, where it shows that the same dot again, but now it's going out the next 5 years. And it's showing from today, so from previously, using history as a guide, when the stock market, or the S&P 500, has been trading at around a 21 valuation, very little upside in the next 5 years. Whereas if it's back down to the left side of the chart, you see much more potential. Now, this doesn't mean that for the next 5 years, the markets won't make money, but very, very high probability that the markets will pull back. And if you have some dry powder to put into action when that does happen, that's how you can manage through these market times. And again, I don't think this is really statistically market timing. It's being aware of where we are today. And I think that chart, it can be a little bit scary if you just have your money in today, all invested, and you have no opportunity to manage or to even add money for the next 5 years. It doesn't bode well. Now, 3 months from today, that number could be back down to 15. And actually, this next chart, it's called Reflection Points. And just, you can sort of go through at your leisure and maybe pause the video here and look through this. But really, really, what I see here, every time you look at a PE of 15 or above, or like say 20. So look in 2000, around 2000, PE trading at 25. What happened? Well, the markets dipped. They crashed. 2007, the PE trading only at 15.1. So it wasn't even that high. Markets crashed. If we look at February of 2020, obviously before
19,
COVID, the markets were trading at 19 PE, and today they're trading at that 21. Now, more importantly, or equally importantly, I would say here, if we look back to the 2000s again, after the correction, the PE corrected down to the 15% range before we saw the recovery. In 2007, the PE corrected down to 10 before we start to recover. Even recently, when COVID hit last year, we saw the markets go from a PE of 19 down to a PE of 13. And it seems like just yesterday, and now it's climbed, that 92% up to where it is right now. In the next month or 2 months or 3 months or a year, we will see a correction again at some point, and then that PE will go back down to a reasonable level. And that's when we can capitalize. And that the scatter chart that said from today, 5-year returns are very low. Well, you can increase those returns if you just manage the portfolio and just have, like say, have some powder dry to move into the markets when we do see that PE come back down to more normal levels. I know there's a lot of numbers I just threw at you, but hopefully this, gives us an idea of, statistically speaking, the markets are pricey right now. Still be invested, but just use a little more caution than you might otherwise use. That's just, those are my kind of, baby boomer thoughts. But also, I worked with clients through all of these types of cycles over the years, and I saw the emotions that people go through, normal, average people, and we all feel those. So don't ignore those. Be aware of them, and things are pretty heady right now.
You gotta do a mic drop after that, Dad.
That's a lot of talking.
Wow, I like it. Markets are expensive. There's your takeaway. Yeah, jeez. I mean, I don't even know how to follow up with that. Hopefully, that gave the viewers just some very, very statistical perspective. Because at the end of the day, the numbers don't lie. When you look back at those data points, the 5-year averages when P's are high. I mean, we're not trying to paint doom and gloom, but
not at all. Yeah,
the numbers are there for a reason, right? The data, they grab those data points for a very, very, very fair reason, and these are all just parts to consider as part of the overall process. But that's awesome.
I think what I just said, hopefully, if I can summarize that in a few words, is don't ignore this information. Go out on your boat, but be aware. And if you ignore it, you do that at your own peril. And that's, those situations often don't end well. As we mentioned, Brandon, these portfolios, and personally, we still have most of our money invested. So, it isn't a doom and gloom scenario because opportunities will come up here. And if you're a long-term investor, heck, if your portfolio does take a 30% hit, you should be prepared to ride that out. If you need that money today, well, it shouldn't be invested in the markets. But if it's for longer term, then nothing really scary out there. In fact, I would welcome the next pullback because, we could put some extra money into the markets. But right now it's just it is a little bit on the aggressive side.
For sure.
That's my 2 cents worth. That's my 10 cents worth today. I think I talked a lot.
That's like $1's worth of advice. Yeah. Well, hey guys, let's wrap up the video there because we are getting quite into it. But if you guys did enjoy that and if you appreciate the content here, please do drop a thumbs up. The thumbs up helps the channel so much. It actually gets the video shown to more people. So if you did enjoy any of that, that's a great way of supporting us. Do you have any final thoughts after that, Jed, or you're out of words at this point?
Well, I'm out of breath, let alone out of words. So no, I think I could just sort of keep reiterating things, but I think we've kind of gone through, and hopefully this will pobide some guidance and it'll resonate with our viewers.
I think so, and I think just to add on, like one of the biggest things, that actually reminds me, if you guys do want to check out more of what we have to offer beyond the YouTube channel, check out our academy because we do offer a private membership group. We have training courses if that is up for you. But one of the biggest things that students take away when they join our membership group or they look back at our previous trades, there are periods where you go with these sometimes long sustained periods where the buys are so infrequent, and then you decide when to go in and kind of load up the truck, right? And that is kind of what we're displaying here live for you guys. We're in one of those periods where we're just not, choosing not to buy for the various reasons that you talked about and more. But that, knowing not when to buy and knowing when to be patient is probably equally as important as knowing when to buy and when to load the truck. So hopefully we're showing that to you guys with this portfolio building challenge. Again, if you want to stay up with like the live time updates, exactly when we do things, and get email updates, that's in that first link down below. But that's, I think we can wrap it up there. Sure. If you guys are not subscribed to the channel, we post videos every single week. You can go back and watch all the previous ones in this series if you want to see the progression thus far. Honestly, I think we can wrap it up there. Yeah,
I think we've kind of covered off what we would like to, and I look forward to the next update, whether it's in a month or so. We were about 5 weeks this time. We'll try and keep it to that 1 month, but who knows? It could be earlier if we see a lot of activity out there in the market. So we'll keep you up to date with what we're doing.
For sure, and maybe that's a good question for those that have stuck around all the way through. If you made it all the way through here, we'll know because you answered this question. Yeah. But would you guys like to see more updates, even if we're not doing things? Like, for example, we didn't make as many purchases over this last period, so our review went a little bit longer than usual, or our space between the reviews. Would you guys still want the frequent reviews just to keep you updated in terms of whether we are or not doing something? Maybe you guys can leave a comment down below, because that feedback will be taken into account.
That'd be valuable. Yeah. Good.
Well, hey, thank you guys all for watching. Dad, thanks for taking the time here this Saturday. I'll get this video posted either tomorrow or on Monday, so that's when the viewers will be watching, but I think we can take the rest of the weekend off and enjoy.
Love it. Okay, actually tomorrow, Brandon, we're doing a session with our Academy students, a live session tomorrow morning.
We're not taking everything off. We got a session with the students, that's right. But
sounds good. Yeah, don't take tomorrow off, okay?
No, I'll be there tomorrow.
All right. Thanks, Brandon.
Yeah.
Great to see you. Thanks everybody for watching.
All right, see you guys in the next video.